Welcome to the Agent of Wealth podcast with Marc Bautis from Bautis Financial. In this podcast, Marc helps guide you towards financial freedom, ensure you never run out of money, and create a balance in life that prioritizes what is most important to you. Join us for this journey as Marc draws from years of expertise and guest experts to solve the multiple wealth building challenges involved in your financial life.
Welcome back to the Agent of Wealth. This is your host, Marc Bautis. Today I'm joined by John Williams, and we're going to talk about the One Big Beautiful Bill Act, or otherwise known as the acronym OBBBA. After years of, we've been planning with clients, people we work with, and a lot has come up with when we're doing tax planning, where we talk about a lot of the tax revisions or tax changes that happened as part of the Tax Cut and Jobs Act in 2017. They were all set to, not all, a lot of them were set to expire at the end of 2025. So we were looking and trying to figure out, well, what do we do? What opportunities are out there, with the thought that, okay, there is also a chance that a new tax bill would get passed. And that's what happened on July 4th of this year. So on today's podcast, we're going to talk about this 870-page bill, what planning opportunities are out there. We'll also talk a little bit about some of the tax concepts that are discussed in each of these areas, because a lot of times I think there's some confusion around what certain acronyms in tax jargon mean and what they're related to. So we'll cover that as well. This is a big bill. We could probably talk for hours. So what we did is really put together which areas that we think are the most important and where the most planning opportunities lie. John, I'm going to start it off with you. The first area we're going to talk about is SALT, or state and local taxes, and what changes have we seen or are we seeing in the bill related to this?
Yeah, this was a big one, especially when you're referring to the Tax Cuts and Jobs Act. They reduced this significantly, and it made a huge difference for a lot of the folks we work with, especially anyone who's working in who lives in areas where the property taxes are really high. That's the biggest part of the state and local taxes is the property taxes. And as many of those who are in the New Jersey area, New Jersey is notorious for having high property taxes across the board. But there's some areas, including Montclair, where we are, where the property taxes are really high. So they reduced it to $10,000. The long and the short of it is they've increased it to $40,000 in the new act. There are some phase outs, which I'll get here to in a second, but this will allow those folks who are actually going to go back to itemizing. When they reduced the $10,000, they reduced the SALT cap to $10,000 back in 2017. They also increased or doubled the standard deduction. So this made it for most people. I mean, I think I remember hearing as high as 90% of people were actually using that standard deduction, because the standard deduction was so high and the SALT cap was so low that it just made more sense for people to take advantage of that higher standard deduction. Now there's gonna be a lot more, I think, planning opportunities, because they've increased it to that $40,000. Some of the nuts and bolts around that, it's going to start in 2026. It's set to go through 2030 and revert back to 10K. But as we know, there could be some new laws around that time, and we have a runway of about 4 years that'll increase to 1% annually from 2027, 28, and 29. So you will see a slight increase for that. For those families who are high income, have a high AGI, for single filers around $250, it's going to be $250,000 is going to be start a phase out. And for married filing jointly, you're going to see $500,000 as a phase out. And it's a little bit different than what some of the phase outs we look at. So you're basically looking at the deduction will be reduced by 30% in excess of that amount. And with that, the minimum deduction allowed will be $10,000. So for every dollar above $500,000 for MFJ and $250,000 for single filers, you'll see a 30% increase for every dollar above that amount until it's obviously gone. So up to that $40,000. So if you have there's going to be that sweet spot. And just as you're thinking through this, if you're in that range, there still might be an advantage for you above, in and around, especially if you're below $500,000. Planning opportunities here are really going to be those who may even remember itemizing because of the before they limited the SALT cap. and just taking a second look now and looking at your income and see if you're going to qualify for some of these to maybe potentially switch from using that standard deduction and getting back into itemizing.
Yeah, one of the topics you brought up was AGI and MAGI, and I just wanted to make sure that everyone was clear on what those two are, because they do have a lot to do with some of these phase outs and different tax areas that we're talking about. So AGI is an acronym for Adjusted Gross Income. And what this is it's all your income, right? So your wages from work, or if you're a 1099 contractor, any dividends that or interest that you may have earned from investments, business income, maybe you have a rental property, minus some certain adjustments, which could be like your contributions to a retirement plan or student loan interest. And the reason why it's important is because it's basically what your tax liability is going to be based off of what your income is on. And it's the starting point for calculating taxable income. Now, modified adjusted gross income, which is what we're hearing, like certain deductions are based and they phase out and you're not eligible for them if your income is over a certain MAGI, which is modified adjusted gross income. This is your AGI, but also some things that get added back into it. Some people like to invest in tax-exempt muni bonds. That interest is tax exempt, but for the purposes of calculating MAGI, it gets added back into it. Your retirement contributions get added back into it. So just want to make sure you understand kind of what is my total income, how does that get reduced, whether it's adjusted gross income, and then how do things get back added to it for modified adjusted gross income. And that's used to determine, well, one, what total tax you're paying, but also what types of deductions or credits you're eligible or not eligible from.
And they don't make it easy for you because there's some are actually AGI, some are MAGI, so you have to kind of be really careful as to what they're actually looking at, a potential reduction in taxes or a credit, what they're looking at, because they can be different for different folks.
Yeah, definitely. All right, so the second area I want to talk about were changes to tips and overtime income. So I think the tip culture in the U.S. has kind of gotten out of control. There's like these self-checkout kiosks I've seen that are asking for tips, but that's a discussion for another podcast. Changes to taxes are beginning in this year, so 2025, a new above-the-line deduction for those making money on tips of a maximum of $25,000 you're able to deduct. Now that deduction is reduced by $100 for every $1,000 that the filer makes above $150,000 if they're single and $300,000 if they're married filing jointly. So again, here's a tax deduction. However, if you earn over a certain amount, you start losing the ability for that deduction. Now, use the word above the line deduction in there, so I wanted to explain what above the line and below the line deduction is. Above the line deduction, it's a deduction that's subtracted from your gross income before your AGI is calculated. So again, referencing the AGI. These are called adjustments to income. So you can claim this type of deduction whether or not you choose to take the standard deduction or if you itemize. And in a little bit later, we'll explain what the difference is between those two. As an example, like your contribution to a traditional IRA or a health savings account, the deductible portion of self-employment taxes, student loan interest, education expenses, those are all above the line deductions that get deducted off of your gross income. So what's good about this is it helps reduce your AGI, which therefore, one, you pay less tax, two, you may be eligible for other types of credits or deductions. Now, below the line deductions these are ones that are subtracted they are subtracted from your AGI to further reduce your taxable income. However, you can only claim these deductions if you itemize, which you can either itemize or you can take the standard deduction. So you only would itemize if your itemized deductions are greater than the standard deduction, and we'll talk about the changes to standard deduction in a second. But it's important to know that above the line deductions are a little more advantageous than below the line deductions. So if you are you have a job where you are either making overtime or earning tips, you may be eligible to deduct those from your income. Now, like everything that we've been talking about so far, and a lot of what we're going to talk about, these are these do phase out at $150,000 modified adjusted gross income if you're single, and $300,000 if you're married filing jointly. So again, it is a deduction. You just have to make sure you're eligible for it. And also you want to check with your employer that your tips and overtime are being reported properly on your, whether you're on your W-2 or on your through your payroll. So again, it's another change that this was something that there was never the ability to deduct tips or overtime. Now that's something that's come up. All right, the next topic we're going to talk about the Senior Standard Deduction, which is a new concept as part of the bill.
Yeah, so back when the Tax Cuts and Job Act was implemented, they did increase what was called the standard deduction, which, just to kind of touch on that really quick, that will get extended. There was basically an increase. That increase will continue and will actually adjust for inflation every year to try and keep up with inflation. Some of the things that were involved there, I think, are point out, because there are additions. It's actually not just senior, it's actually senior and blind. And if you are filing single, your standard deduction is $12,750. And if you're marrying filing jointly, your standard deduction is $31,500 to start before any additions, if they are applicable. If you're single and you are 65 or blind, one or the other, you can add $2,000. So if the standard deduction is $12,750, you now use a standard deduction of $14,750. If you're marrying filing jointly, there will be a $1,600 per person who falls into that category. And again, that's blind or 65. Now, there is also an opportunity, if you're both blind and 65, to actually double those numbers as well. But for all intents and purposes, if you're 65 and you're married filing jointly, you'll receive $1,600 per person who falls into that category. Additionally, from the One Big Beautiful Bill Act, if you're 65, you'll be able to add to your standard deduction an additional $6,000. Anyone who's over 65, starting in 2025 through 2028. And that's per filer. If you're looking at marrying filing jointly, that could be up to an additional $12,000 added onto your standard deduction for that year. Single filing jointly would be $6,000 for that one person who's filing. And there was a lot of talk around when they were looking through this bill as to whether or not they were just going to look at Social Security and just reducing the tax on Social Security. I'm kind of happy they just went with okay, if you're just to make it simple, the Social Security tax is convoluted as it is. So if you happen to be on 65 in the year of 2025, you'll be able to take advantage of that additional $6,000 or $12,000 if you're married and filing jointly. I need to add, though, that there is going to be a phase out when it comes to the income that you potentially have. If you're filing single, the phase out will start at $75,000. And if you're married filing jointly, it'll start at $250,000. The way that the deduction on this phase out will work is it's decreased by 6% for every dollar the filer or filers are above those limits. So just 6 cents on the dollar for every dollar you're above that 75 or 250 respectively.
Yeah, the phase out seems to be a common theme amongst a lot of these different changes. But
yeah, well, it's expensive too. I mean, if you look at I think it's going to cost them $1.4 trillion over 10 years. So I guess they have to kind of look at some of this higher income folks who are making some money and start to phase them out.
Yeah. All right. Next, I want to talk about the infamous Trump accounts. So what these are government funded investment accounts designed really to save for your child's future. You give them a head start. When they reach adulthood, they start saving early. And how these work is every baby that's born in the U.S. between 2025, 2028 is eligible for this, call it free $1,000 from the government. To qualify for this, there are certain criteria that I mentioned. The baby has to be born between January 1st, 2025, December 31st, 2028. It may be extended past that. They have to be a U.S. citizen. And actually, immigration citizenship is kind of at the forefront now. The parent's citizenship actually doesn't matter. It's only the child that matters. A couple things you need to know are that the money, this $1,000, it's not automatic. It doesn't just appear. You need to actually open up an account at a bank, qualified financial institution. We're still waiting on some details on what actually those are to receive that $1,000. Now, if you don't voluntarily or create one, the government will establish one. However, you still need to meet a certain criteria to be able to access it or claim it. You can contribute more money to this $1,000. You don't need to, but you can. So the contribution structure, it gets a little bit complex. There's an annual contribution cap of $5,000 per year on these accounts, and actually anyone can make them. So it can be a parent, a relative, or even a friend. They're after-tax contributions, so no one is getting a deduction to that up to that $5,000 limit that's contributed. Employers can even contribute on their side. They do get a tax benefit of $2,500 that they can contribute up to. It does count to that $5,000 limit. There are some restrictions. They are pretty specific. So the funds must be invested in what's considered a qualified mutual fund. So it has to either track the S&P 500 or some similar U.S. broad stock index. You can't have like a sector specific. You can't just say I want to invest in tech stocks. They must be low cost funds. So the annual fees on these mutual funds has to be at or below 0.1% of the fund balance. No individual stocks, no Bitcoin, no alternative investments. The rules on accessing or withdrawing money from the Trump accounts are you cannot access the money before the child is 18 years old, except in the case of the child's death. The money must stay in those qualified funds. Now, once the child turns 18, the Trump account essentially turns into the same rules that an IRA has. So you can withdraw. However, they're subject to regular income tax on the earnings from there. So just to take a step back, there's no tax deduction for the money going in. You get to defer tax on the gains or interest or income that the account earns. When you take money out of the account, you're going to pay tax on those earnings and interest. However, any after-tax contribution, it can be withdrawn tax-free. If you take money out before you're 59 and a half, you have that 10% penalty in addition to the income tax. That's similar to the way an IRA works. And similarly, the penalty is waived if it's for a qualified expense, which includes higher education, up to $10,000 for a first-time home purchase. And like an IRA, capital gains rates, taxes don't matter. These are all talking about ordinary income tax that's withdrawn. So now planning opportunities that arise from this. You're a young family, obviously it's free money. It's like similar to when people ask us about contributing to 401k plans, take the match. It's free money. This similarly is free money as well. So open up that account, get the $1,000 government contribution. In terms of adding up to that $5,000 limit each year, you want to consider this along with 529 plans, Roth IRAs for your kids, regular savings accounts, and just see what makes sense. There's pros and cons to using each of these types of accounts. Like I said, the contribution is great. Just as an example, if you put $1,000 in at birth, you can be looking at $8,000, that account being worth $8,000 by the time they turn 18. Obviously depends on what the growth in the investments or in those funds are. It could be a good teaching tool for your children just to learn about investing. Now they have something tangible that they can look at and see. Gives them a head. This technically is a retirement account with it turning into the IRA at age 18, so it can give them a head start towards retirement. Now for estate planning, so you can have multiple people contributing to this. So grandparents, aunts, family, friends, they all can contribute. It follows the same rules as the gift tax does. So like if someone's giving money to another person in 2025, they can give up to $19,000. This, if they gave $5,000, which is the max on these types of accounts, that counts towards that $19,000. So, these are things definitely to consider. And at a bare minimum, I would say you have a child in 2025 or up to 2028, definitely take advantage of that free $1,000.
Yeah, I was also thinking that this could also be like an opportunity for companies to actually add to their benefits suite, because it does talk a little bit about how companies are going to be able to contribute as well. So I could see someone getting hired and saying, "Hey, as part of our benefits suite, we'll contribute if you have a baby $2,000 to add to that." So I thought that was kind of interesting too. They added that corporation's opportunity in there too.
Yeah, and this is nothing like the Trump account concept is not new.
Yeah.
And there's probably ways they could have implemented it maybe a little bit, I would say better. But for a start of getting children saving early, even if it's on their behalf and they have no idea about it, I think is good. And I think what they're probably doing is just looking for where all the different avenues where money can get contributed into this Trump account. All right, next we'll talk about some changes to charitable deductions.
There's a few layers here, but some pretty sizable changes to the way you can contribute to or deduct charitable donations, whether you're itemizing or you're using your standard deduction. The first is that they'll limit your deduction to 35%, regardless of what your tax bracket is. The biggest effect here is going to be on those who are in that 37% tax bracket. Because an example we'd be looking at is if you're in that 37% tax bracket and you were to donate $1,000, your deduction would be $370. But because of this 35% cap, it'll be in that example only $350. They're basically looking at limiting that top tax bracket as to how much they can deduct those charitable deductions. And it also introduces a floor for charitable deductions for individuals and families who elect to itemize. And this floor basically will be 0.5% of your adjusted gross income, or AGI. And your charitable deduction will be limited to the portion of your contributions that exceeds this amount. It's probably better explained in an example. So basically what we're looking at is if your AGI is $100,000, you must donate over $500, which is 0.5% of $100,000 to receive the deduction. So basically what we're looking at is your AGI times that 0.5, and then that'll basically set your floor, or the amount you need to get to before you can start to add that deduction on. And then for those who find that it's not going to be necessarily beneficial to itemize, and for whatever reason, or they're not really going to be making significant charitable deductions, but still want to claim that deduction and make those charitable deductions, individuals and married couples will be able to deduct $1,000 for single filers, $2,000 for married couples, and these will be above the line deductions, which I thought was interesting. So it will actually reduce your AGI for qualifying for other deductions, but $1,000 for single, $2,000 for married couples. Some of the planning opportunities here will mostly be for those high income earners who are considering a significant philanthropic gift over the next few years. They might want to accelerate that and consider doing that in 2025 ahead of these changes. Because even if it is just that 0.2% difference between 37 and 35, obviously every little bit counts, and they could potentially take advantage of, if they have the money and they can do it in this year, and it's something they're considering doing, then it might make sense. High income individuals who are itemizing, they could also consider the timing of their giving and the strategies that might maximize these deductions. And really what we're looking at there is potentially bunching these contributions together. So let's say, for instance, if you have $10,000 you're going to give in 2025, and you were planning on giving another $10,000 in 2026, it might make sense for you to just lump that $20,000 in with 2025. And looking at the frequency, there might be ways for you to save through the bunching and the frequency.
And I want to talk about bunching a little bit in the context of the changes to standard deduction. So as part of the bill, the standard deduction, the amount increased. And just to go over the actual numbers for it. So if you're single or married and filing separately, the standard deduction is $15,750. If you're the head of household, it's $23,625. If you're married filing jointly or a qualifying survivor spouse, it's $31,500. So you can think of the standard deduction of the amount basically of your income that you get to earn without paying any tax on it. So in the case of married filing jointly, $31,500, that amount gets subtracted off of your income, and you won't have to owe any tax on that. Now you have a decision to make when you file your taxes. You either decide to take the standard deduction, or you can itemize your deductions. Now with the standard deduction increasing as part of the bill, and I think you mentioned 90% or 95%, it's probably going to be even more that are going to take the standard deduction, just because not that many people are going to have the ability, or their itemized deductions are going to be over $31,500 if they're married and filing jointly. However, like you mentioned, bunching is a strategy, especially if we combine some of the things we talked about. So we talked about SALT earlier, the state and local taxes. If you live in one of these high property tax state, income tax states like New Jersey, New York, California, there's a chance you're paying a lot in property taxes and state income tax. Then you also look at your charitable contributions. So if you are making a lot of charitable contributions, you may have more, that number, your state and local taxes plus your charitable contributions, may be over the $31,500. And in that case, it makes sense to itemize. But maybe it's not. And taking the itemized deduction will be better. However, the way bunching works is you say, and we'll just look at charitable contributions. Forget about SALT, the state and local tax, for a second. Let's say I want to make $20,000 a year in charitable contributions. Well, $20,000 is below $31,000, so I would still take the standard deduction. And the one thing you mentioned that was interesting is that you still actually can deduct, I think it's up to $2,000 as an above the line deduction for charitable contributions, even if you take the standard deduction. But you're contributing $20,000. It's less than $31,000. You technically don't get credit on your tax return for it because you'd still take the standard deduction. However, the way bunching would work is you could say, okay, in year one, I'm not going to make any charitable contributions. I'm going to take the standard deduction. Year two, I'm going to do both years of charitable contributions. I'm going to make $40,000 of charitable contributions. Therefore, $40,000 is over $31,500. So I get a bigger benefit on my taxes if I itemize than take the standard deduction. And then maybe the following year you go back to zero, and then the year after you're back to $40,000, and you're switching back and forth between itemizing and claiming the standard deduction. So there are strategies that could be involved dependent upon what your state and local tax or what you do with charitable contributions are, where you can take advantage of it. A couple of the other provisions of the bill that I think are worth noting. One, there's a change to the child tax credit where it was increased from $2,000, which was passed as part of the Tax Cuts and Jobs Act, to now $2,200. And one reason I'm bringing this up for is that the child tax credit is one of the few federal tax credits that actually has a high income limit before it starts phasing out. The child tax credit phases out at $400,000 if you're filing jointly, which is higher than I think almost every other tax credit, tax deduction that we've been talking about. Next thing that I wanted to bring up, there have been some changes to 529 plans and eligible expenses. So it used to be you could use up to $10,000 to pay for any private K-12 expenses. Now you can use up to $20,000 per year per person. You can also use it for books, online learning materials, tuition fees. One thing I really recently found out that isn't an eligible 529 expense is college application fees, which I was surprised about because I thought your 529 can be almost used for anything when it comes to higher education. The one thing I say is that it can't be used for travel to and from school. Application fees are another thing that it can't be used to, which I found a little bit surprising. Next thing, a new deduction is you can deduct actually car loan interest, which you never were able to do that if you had a car loan that was for a personal use vehicle. So not a vehicle attached to a business, but one you use personally. The way this works is the deduction is available for loans that were originated between January 1st of this year and December 31st of 2028, where you can deduct up to $10,000 in interest per year. Now, deducting up to $10,000 of interest on a car loan is probably difficult to get that high because you really have to have a high valued car and car loan to be able to get to pay $10,000 of interest each year. The deductions in above the line deduction, which means you can claim it even if you're claiming the standard deduction. There are income limits. So the deduction phases out with people with a modified adjusted gross income if you're single over $100,000 and is completely phased out at $150,000. If you're married and filing jointly, the phase out begins at $200,000 and fully phases out at $250,000. To be eligible for the deduction, you do have to meet your vehicle has to meet a couple and loan have to meet a couple of specific criteria. So it has to be a new vehicle. You can't purchase the used car. The car has to be assembled in the U.S., a final assembly in the U.S. The vehicle type, there's certain criteria on the type. It can be a car, minivan, SUV, pickup truck, And a motorcycle, however, it has to weigh less than 14,000 pounds. And I think this is just lending to it. This has to be a personal use. You get above that and you're pretty much talking about commercial vehicles. The vehicle has to be financed with a loan. It can't be a lease. And this whole deduction, it's really an example of how the government uses the tax code to motivate people into behaviors that they want to see people take. Here we're saying we want you to spend money and buy cars, and we want you to buy ones that are made in the USA. If you can meet the specific criteria, you're buying a car in these next 3 years, you may be able to deduct the loan interest on it. Another one that is interested is that the electric vehicle and residential credit has been repealed. So again, they're making all these changes where you can do this. Now, automobile space in this, they're giving you credit, a deduction for buying a car made in the US. However, you're losing the credit where if it was an electric vehicle. So just goes again to show you that, they're really trying to specify certain behaviors that they want to see people take. All right, so we covered a lot. Like I mentioned earlier, there's a lot more in here, and everyone's planning opportunities relating to the bill. They're going to be different. If you'd like to discuss how the bill impacts you specifically, you're more than welcome to schedule an intro call with us at bautisfinancial.com. At the top of the page, there's a button to schedule a call. It's a free consultation. We'll also include some resources that we have on the bill and in our show notes. Like one example is a checklist that we have, so you can kind of go through it and mark off ones that you may want to look more into, and it'll kind of guide you through, oh yeah, this change may impact me, or this one definitely doesn't, or this one definitely does, and kind of just help guide you through that process of figuring out where to go next. Because it is a little bit overwhelming. It is a 870-page bill, and a lot of these deductions, credits, it can be a little convoluted and complex whether you can benefit from it or if it's not applicable to you. So thanks, John, and thanks to everyone who tuned in today. Don't forget to follow the Agent of Wealth on the platform you listen from and leave us a review of the show. We're currently accepting new clients, and if you'd like to schedule a one-on-one consultation with our advisors, please do so at bautisfinancial.com/call.
Thank you for listening to the Agent of Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered represents the views and opinions of the guests and does not necessarily represent the views or opinions of Bautis Financial. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional financial planning and investment advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investments and financial planning.